Hey guys, in this video we're going to talk about the top mistakes that people make when they are buying ETFs or exchange traded funds. I'll also tell you more about a special report that I put together with the Motley Fool. You can find that report at fool.com/Arvabelle. It's totally free, and that's the only place that you'll be able to learn more about those top 5 stocks that I'm watching, since I won't be talking about them on this channel. Mistake number 1 is chasing trends. So there are tons of ETFs that are added every year that are brand new. Oftentimes this is hundreds of ETFs, and pretty much any specific little category that you want to look for, there's probably an ETF for it or an ETF on the way. Whether that's EV companies, vegan companies, gold companies, whatever you can think of, there's probably an ETF for it. These themed ETFs can be risky if those companies in that trendy sector don't do as well as expected, or if that trend just dies off completely. If we go back to the Little Book of Common Sense Investing, John or Jack Bogle's thoughts on sector-specific ETFs were to use them sparingly if you want to use them to diversify. If you do want to look into these, be sure that you're doing your research on the management, their expense ratios, looking at all of their annual reports. Look at what companies are actually in these ETFs and determine for yourself whether or not you think that trend will stick around for the long term. Mistake number 2 is buying ETFs that you don't understand. So there are a lot of different types of ETFs. There aren't just ETFs that track the S&P 500. You can find leveraged ETFs, you can find short or inverse ETFs, you can find future-based ETFs, and if you don't know what any of those mean, you probably shouldn't be buying them. So many ETFs that are available do just track an index, and for most people that's a pretty easy concept to understand. But if you do want to venture out into these different types of ETFs, be sure that you are learning as much as you can about what is actually behind that ETF. So if you are wanting to trade ETFs that are leveraged or that are inverse, make sure that you know what that actually means. So how much leverage does this ETF have? And how does that leverage typically affect an ETF over the long term? There are so many resources available for you to go and research this and to go and look at past ETFs that were similar and see how those performed. So there really isn't a reason that you shouldn't be researching this stuff before you actually buy into it. But going back to even just our basic ETFs that track an index, you still need to know what is actually behind those. So don't go buying an ETF just because someone told you that you should have an S&P 500 ETF in your portfolio or a total stock market ETF in your portfolio. If you don't know what the S&P 500 is, that's probably where you should start. Learn what that means and go from there. Mistake number 3 is actually never looking into individual stocks. So ETFs are a great way to start building your portfolio, but for some people, they just have a really hard time actually wrapping their head around what an ETF is and how it works. Or it's just a lot easier for them to understand the fundamentals and the performance of individual companies. So if that's something that you're interested in, then individual stocks may be something to look into. Because ETFs have very diverse holdings, if one company in that ETF does super well and sees explosive growth, you won't necessarily reap the full benefits of that because it is in there with so many other companies. So the next step for a lot of investors who are looking for higher growth in their portfolios is to look at these individual companies and try to identify ones that you believe will outperform the market. So if you look over the past 5 years, SPY, which is one of the world's largest ETFs that tracks the S&P 500, saw its share price rise 103%, which is fantastic. But over the same time period, several well-known companies saw returns that were 2 times, 3 times, even 5 times the market. Like Alphabet, which owns Google, they were up 243%. Amazon was up 376%, and Apple was up 460%. And those are just a few examples, but all of those are in the S&P 500, but those individual companies saw bigger growth. I'm currently looking at 5 5 companies that I think have a chance to be big winners and see a lot of growth over the next 5 to 10 years. I've partnered with today's sponsor, The Motley Fool, to put those together in a special report that is available just for the viewers of this channel. It's free and it'll be delivered right to your inbox. All you have to do is visit fool.com/Arvabelle to access my list of those 5 stocks. I don't release stocks that I'm watching anywhere else, so that's where you can find that list and my reasons for liking them, as well as a special offer for new members of Motley Fool Stock Advisor. Motley Fool Stock Advisor is a subscription stock picking service where members gain access to their library of expert stock recommendations, which are aimed at multiplying your net worth. Stock Advisor recommends 2 brand new stocks to its members each month, sent directly to their inbox. Motley Fool Stock Advisor's average stock pick has returned over 500% as of when I'm filming this. That's beating the market by almost 5 times. Again, you can visit fool.com/Arvabelle or check that link in the description to get access to that report and check out the Motley Fool Stock Advisor. Mistake number 4 that people make when buying ETFs is not actually being diversified. So I've seen this with some of my own friends when they first start investing. They'll buy a few different ETFs, not realizing that they kind of bought the same thing. So for example, VOO and IVV are ETFs that track the S&P 500. They're essentially just ETFs that were put together by different companies. So what's really common is that if you are a beginner investor and you don't actually understand what is behind that ETF, whether that's the index that it's tracking or the sector that it's following, you may accidentally buy 2 or 3 of essentially the same ETF. Or, as another example of how you may accidentally not be diversifying the way that you want to, is if you have a goal of having your portfolio made up of a certain percentage of US stocks that are within those ETFs and a certain percentage of international stocks within those ETFs, if you don't do your research, what could end up happening is that if you have your US ETFs and then you buy an international ETF, if you don't look enough into what is actually in that international ETF, you could accidentally buy into one that includes more US stocks than you thought it would. So if that's not what you wanted to do, you could accidentally end up with a larger percent of US stocks within your portfolio than you intended. That's totally just an example, and the same thing could apply to different industries or different type of stocks like small, medium, or large cap stocks, and however you are choosing to weight your portfolio. So the way that you avoid that is to actually research those ETFs, look them up, go to the website of whichever company put that ETF together, for example, Vanguard, and they will usually have a page on there that will show you which stocks are actually in that ETF, and sometimes it will show you a breakdown of the countries that those companies are based out of. Mistake number 5 is not using limit orders. So nowadays, most brokerages are commission free, but some also offer those no-fee ETFs if you are buying their own company's ETFs. So that's great, and in theory is saving you a little bit of money, but if you are using market orders instead of limit orders when you're actually buying into these ETFs, you may be paying a bigger spread than you need to. So if you don't know what the spread is, very simply, it's the difference between what people are wanting to buy a stock or an ETF for and what people are wanting to sell a stock or an ETF for. That difference is the spread, but if you don't specify where you want your order to go through, it does have the potential to fill at a higher price than you wanted, meaning that you would be paying more because there is that bigger spread. That's a super quick explanation of limit orders, but if you need a more in-depth explanation, I'll leave a video up there. Mistake number 6 is actively trading ETFs. So going back to the Little Book of Common Sense Investing, the author Bogle, who was the founder of Vanguard and the creator of the first index fund, said that he made that first index fund as an asset that was intended to allow you to diversify and also to allow you to have an asset that you could just buy and hold. Just because you can trade ETFs doesn't mean that you always should. So if you do want to invest in ETFs, but you need to to remove that temptation of trading them, what you can do is look into mutual funds. Many of them track the same indexes, but the way that mutual funds work, they don't allow you to trade them multiple times within the same day. Mistake number 7 is having a short-term outlook with a long-term goal. So what I mean by that is that if you are buying an ETF and you intend on holding it for years and years, then you shouldn't be panicking if you are seeing like daily fluctuation within that ETF. So if your intent is to hold an ETF for multiple years, don't freak out if the price goes down one day. Definitely don't check your portfolio daily if it's going to stress you out. And also don't expect immediate returns. If you are holding something for the long term, it's important to make sure that your outlook on that stock or ETF matches your long-term goal. ETFs are a great option to look into, so hopefully you can avoid making some of these common mistakes. And if you do want to access that free report with those 5 stocks that I'm watching, remember to check the link in the description or go to fool.com/Arvabelle. And I will see you guys next time.